to this month's episode of Fintech Firebrand. I'm Virginie O'Shea, founder of Firebrand Research, and I'm here to chat to you about this month's Fintech and FinReg news. Now, one of the biggest capital markets news items this month was the approval by the Securities and Exchange Commission in the US of the first 24 by 5 days trading venue for US equities. Now, crypto trading, as we all know, you can do 24/7, and FX is also round the clock. But it's the first time US equities will be able to be traded, and this is going to be approved, and it's going to be launched next year in a phased manner. It will have an interesting impact, I guess, on the rest. Given it's a new exchange, it may have an impact on the incumbent exchanges. I believe I spoke about this earlier in the year, but NYSE did a poll of its participants earlier in the year. It did a survey looking at whether they should also move to 24 by 5 or 24 by 7 trading. They have not yet made an announcement, NYSE or any of the other exchanges, about what their plans are, but it seems inevitable that a move to more round-the-clock trading will happen for US equities in the future. This is an interesting dynamic for those in risk management and operations who will have to support such a move. How does this impact working lives? Obviously, you can automate a certain degree of things when it comes to trading, but when it comes to risk management and the like, you will obviously have to have people involved. You can't automate it. AI is not that sophisticated yet. So certainly a lot of interesting developments there with regards to how we support a more 24/7 operating model. Also interesting to think about what that does to market liquidity. A lot of the trading at the moment currently goes on at the very end of the day. If you don't have an end of the day, what does that mean in terms of peaks and troughs for liquidity? And does it have a negative or a positive impact in the long term? So definitely crypto trading is a very different animal and a different beast to US equities trading. So it will be interesting to see what happens when it launches next year. An interesting and an ongoing dynamic that will happen in the next year and probably the next 4 years is some of the challenges that are happening within the US market around environmental, social, and governance investing. We saw this month that the the Attorney General of Texas has issued a statement about issued a statement saying that it's going to be suing BlackRock, State Street, and Vanguard for what it calls illegally conspiring to manipulate energy markets due to the introduction of ESG screening within their respective organizations. Now, there's been a lot of toing and froing over the last couple of years about ESG within the US. It seems that with the change in administration next year, there will be a further departure in terms of how the US will treat ESG. Currently at the state level, there's a lot of divergence in terms of state-by-state approaches to whether ESG is acceptable or not. We may see more of a federal approach with regards to the changeover. We may see, obviously, we will see the ESG legislation that's proposed by the SEC disappear in the coming months. But it will be interesting to see what this long-term impact has on the US economy with regards to sustainability, sustainable investments. As we see on the other side of the globe, the Asian markets pushing even further towards supporting sustainable finance and green finance, and also incorporating a lot of climate risk into their adjustments and reviews of the industry. So there's going to be two extremes with regards to what happens in the future, and there's certainly a lot of interest going into the next couple of months. A slightly less glamorous topic, or probably slightly less divisive, I would expect, is the continuing global move to shorten the settlement cycle. And now we've seen a lot more progress over the last month within the EU, Switzerland, and the UK in terms of committing to a deadline for the move. We now have a penciled-in date of the 11th of October 2027 for the move for all three different entities to move. I say three entities, the region and the two countries to move to shorten the settlement cycle from T+2 to T+1. We have a lot of planning ahead of us. We have some regulatory changes that have been signalled by ESMA as part of its report. CSDR, the Central Securities Depositories Regulation, will need to be tweaked. That could take a little while to get that done. So we hope to see a lot of movement towards that in 2025. We've also this month seen ESMA put out, in cooperation with industry working groups, a new governance structure for the move. Now, certainly in the US and in Canada, there was very clear leadership with regards to who would be leading the move to T+1. The playbook was published by DTCC. A lot of all of the testing was led by them. It's not quite as simple as that when it comes to the EU. So it is simple. It's simpler in the UK, obviously being one market, and simpler in Switzerland being one market. But when it comes to the EU, obviously there are lots of different entities at play. So relatively complex structure for the governance. There'll be the three main bodies involved: the Commission, the European Central Bank, and also ESMA. So they will be the coordinators of the move. There will also be various industry representatives from the various associations across Europe, and some individual representation as well. So certainly expect much more detail on that. We've got the diagram, the flow diagram as to what it might look like so already. So certainly good to see that there's been a lot of positive movement there. Good to see we have a date to work towards. Obviously, there's a lot to be done before that time. And as we know from the US and Canadian move, it did take a while with all the testing and the like. So certainly we want to see a lot more clarity from some of the market infrastructures on their own plans, and also the testing windows and when they might happen in each of the individual markets needs to be agreed. So much more detail going into 2025 expected, but certainly will be a big topic for me to be talking about endlessly on these every month, no doubt. And another quick item to touch on, Google indicates that it is on the road to quantum computing. It announced this month that it has designed come up with some new chips that could help it in its support of quantum computing. So that's there's been a lot of discussion about the future of computing post-quantum. So certainly there'll be a lot of challenges with regards to encryption, but it's interesting to see how much money is going towards this sort of arms race, technically speaking, towards quantum computing, which will accelerate the pace of technology development by quite some magnitude. So certainly a lot of things to watch there, but another piece of interesting and positive news on the fintech front. And as it's the final Firebrand discussion of the year, I would like to take this time to say thanks to everybody for all of your support this year. It has been invaluable. I've enjoyed working on all of the different projects with all of the different clients, and we've loved working with all of our contacts with regards to putting out our research and keeping our research fresh, particularly in certain areas where there's not that much data. Expect much more from us in the new year. We've got a lot of projects on, T+1 being one of them, of course. That'll be a regular thing for you guys to check back in on us around. And certainly we've got the start of the year, we've got DORA coming out. So operational resilience will be a big topic as well. I hope that everybody manages to get some downtime during the holiday break. I certainly expect I'll be doing that myself. And with that, I'd like to say season's greetings and a happy new year.